Hello everyone, welcome back to Upside Down Data. Today I want to talk about our new version of the UDPI and some of the new features that it offers. If you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter, where we put out regular updates about our risk indicators and more. So if you've been following the channel, you've become quite familiar at this point with our UDPI risk model, our upside downside potential indicator. And essentially what this model does is it identifies risk. So what I'm showing you here is the upside downside potential indicator for Bitcoin. This is the price action of Bitcoin on a logarithmic scale. Each dot is a day, and each day is color coded based on the output of our risk indicator. But as I just mentioned, this is actually version 2. It's an updated version of our UDPI. So I want to say a couple things first. So first off, I don't think that our original UDPI was bad by any means. In fact, I think it did quite well in identifying high and low risk times, not only for Bitcoin, but also for a variety of other assets that we've been monitoring here on the channel. But that said, I always feel like there's room for improvement with any of these things. And there are a few things about the original version of the UDPI that I wanted to make better. I wanted to try to improve upon. And one of the things that I thought the model could do a little bit of a better job of was learn more efficiently. I wanted, the UDPI is a smart model. It learns from the data that it receives. It learns from what it sees with each asset, and is then able to update its estimates about risk accordingly. It's dynamic. It learns from what it's seeing. And one of the things that I wish that the original UDPI could do better was learn more efficiently, to be able to kind of take in early price history and learn from it a little bit more quickly to start then making reliable risk estimates. It didn't do a bad job, but I just thought it could be better. I thought it could be more efficient. And so that's the main thing that I've tried to work on with this next version, to make it more efficient learner. So as it gets in new information, it's able to extract information from that new data more quickly. It doesn't need as much information to train on before it can start making reliable risk estimates. Again, the first UDPI wasn't bad on that. It was able to start making reliable estimates fairly quickly, but this one's just quicker. It's a little bit more efficient on that front end. So what I'm showing you here is kind of the new model. So this is what the model looks like when you give it full knowledge of the price action of the asset. So for Bitcoin, so we can look at the raw output, and I've overlaid the Bitcoin price here in yellow just so we can see how these things relate. Y-axis here is the UDPI, -5 to 5, and again, this is the updated version. And just like the old version of the UDPI, version 1, it acts very similarly. You see it spikes up to, up above 4, right around 4 for every single market peak, or, if you consider the spring being a cycle peak. Technically it's not, because this was the market cycle being a parabolic rally, at least a mid-cycle peak like we saw back here. Spikes up to those same levels, and then gets down to these really low risk levels here as well. But one thing that it's able to do is kind of interpret this early price action a little bit more efficiently, and then use that, then carry that knowledge that it's gaining early on to then interpret new things as it sees them. Now, of course, a question that you can have then with these models, as I said before, this has full knowledge of Bitcoin's price, and it's making these risk estimates based on that full knowledge, even going back into history. So the question you then have to ask is, can the model do this in real time? And is its real-time output, does it look just as good or better than its output when it has full knowledge? Another way of framing this question is all of this just hindsight bias, its interpretation back here, or would it have printed very similar output if it had no knowledge of the future, if it had just been going in real time with only knowledge up until that day when it was printing a risk estimate? So as we've done on previous videos, we can actually test this. We can run simulations to test how this model would perform with only real-time price action compared to a model that has full knowledge. And as I mentioned before, one of the big improvements of this model is how efficiently it can learn from what it's seeing and then make reliable output. And what's really cool about that for the Bitcoin UDPI, the version 2, is that when we do these simulations where we start it, kind of in real time, the amount of data that we need to train the model before it's able to then just go and kind of do its own thing, go in and just interpret price action, interpret risk accurately, it really does not need that much. So what I'm showing you here on the top graph here is the model with only knowledge of real-time price history. And what I mean by that is that for every day here, for every dot, the UDPI is calculated with no knowledge of any of the price action that comes after. So for example, on this dot here in late 2011, it has no knowledge of anything that comes past. And then for that next day, it has no knowledge of anything that came after that. Same thing, as it gets up into this point. No knowledge of anything comes back here as it's giving its UDPI readout. So hindsight bias is impossible in this model. It has no knowledge of anything that comes past. The only thing it knows is the day, that data, and all the data that came before that day. It knows nothing about the data that comes after. And what you can see is that if we can compare this kind of simulated, like it was in real time, like you just created the UDPI back here and let it run, and these are the numbers it would have been producing throughout that entire time. We can compare that with with a model that has full knowledge of Bitcoin's price history. And we can see is that they're very similar, and in fact, the one that's running in real time almost seems to be giving clearer signals than the one that has full price history. And we actually see this, I think, a little bit more clearly if we just look at the raw output, and I just have, again, price in yellow overlaid on top. And what you can see is that this model that's basically running in real time, this is the output it would have been giving you if it had been running in real time, starting back in late 2011, mind you. So this has only a very little amount of data fed into it before it's able to start doing this. You can see that it's actually giving, if anything, more clear readings of risk than the retrospective model, the model that has full knowledge of Bitcoin's price histories. You can see that even in this 2013 mid-cycle peak, shoots up to 5, comes back down into the negative, shoots back up to 5 at the actual market cycle peak in 2013, and then comes down into this bear market, very low risk, then shoots up back to 5 for the market cycle top in 2017, way back down to super low risk again in the bear market of 2018, shoots up for this little run up, this mini bull run in 2019, and then again shoots up above 4 for this kind of mid-cycle top that we had here in the spring, the first part. And then, arguably we're still in a bull run to go to maybe put in the second leg, sort of like we did in 2013. That's yet to be seen. And you can see that if anything, it's just navigating that more efficiently than the retrospective model. And so that, in my opinion, is the way you'd want one of these models to be. You want the model that's giving you really, really useful output to be the one that's running in real time. The retrospective model, when you look at this, what it's saying about the past doesn't really matter all that much. We don't, frankly, really care with this model what it's saying about the past. We care about if its real-time output is likely to be reliable, if it's likely to be accurate. And what you can see is that with this model, if you had created this model back in late 2011, it would have given you very reliable output about the risk level of Bitcoin in all those years since, and all the days after that. It would have been giving you this reliable output. And I want to just stress this again. This model, on this graph that you're seeing here, it's as if you built the model back here and then just let it run. It knows nothing about the future. It cannot be biased by hindsight. These are literally the values it would have been giving you in real time through all of this time, for this entire period. And just imagine what you would have been able to do trading Bitcoin with a model like this in your pocket. Just look at this. And I'm going to be putting out another video sometime in the not too distant future where I actually do some simulations of investing strategies based on this output, based on this new UDPI model, based on this output. And I'm not going to spoil it, but it's pretty insane the returns you could have gotten trading based on this, and you would have obliterated a buy and hold strategy. So watch out for that video when it comes, but it's pretty remarkable what one could have done having this model back here. Obviously holding Bitcoin for this whole period would have been great. Turns out it would have been even better if you could have been basing your investments on a model like this. So you had this new version of the UDPI back here. So I think that's pretty remarkable in some ways. The fact that it's able to learn so efficiently that it can start running in late 2011 and then accurately call every single market cycle top and every single bear market bottom quite well like that. But it turns out there's also more that we can do with this model. So this is just kind of to build confidence that that I think that it's giving useful output as it goes through. But we can actually look a little bit further. So another thing that we can do with this model that I think is really neat is we can actually tell it to focus on different types of risk. So there's different ways that you can conceptualize risk. You can think of risk in a market cycle context. When are we likely at the bottom of the bear market? When are we likely at a market cycle top, or at least a mid-cycle top? That's kind of a macro, in my view, or a longer term risk assessment. It's really asking the model to give you this more macro picture of the risk level. And that ends up this is what I was just showing you, actually, was the longer term viewpoint of the UDPI that's supposed to just call out these high risk kind of macro zones and these low risk good accumulation kind of macro zones. But with this model, we can actually also tell it to focus on different things if we want to. So one of the things we can do is we can say, what if I'm more interested in a bit of a more medium term risk, right? I'm concerned with these kind of market cycle tops, but I also want to know if we're maybe getting to kind of riskier points within those cycles. So for example, as we're kind of running up through some of these bunny hills, I want to know more about this volatility here and when we might be kind of getting a little bit overextended versus underextended within these runs, within these market cycles. Maybe if I wanted to take a slightly more active trading strategy to try to maybe trade some of those. That's what this one is giving you, a more midterm UDPI output. That's still going to give you kind of the macro overall context, but it's going to give you a little bit more information about where some of these smaller kind of bumps in the road, where they land in a risk perspective, if one wanted to trade based on that. And then this final pane that I'm showing you down here is the short-term UDPI. And this one is really trying to tell you about short-term upside versus downside potential. It's still going to tell you, when things are likely kind of topping out, but it will also be telling you within that a lot more clearly within these kind of little runs when you're low in the short term, when your downside potential is likely tapped out, but also in the short term when your upside potential might be getting relatively tapped out. So if one wanted to take a more active trading strategy within a market cycle, one could look at a UDPI like this and get an idea of when the short-term downside potential has likely been tapped out and when the short-term upside potential has likely been tapped out. And so I think we can see the differences a little bit more clearly if we look at these graphs where I'm showing you the raw outputs of the UDPI. And what you can see is that the longer-term model is less concerned about just these kind of really small movements in price history. And it's more concerned with these broader movements, these longer developing movements, and when they're likely tapping out. Whereas with the medium term, you can see it's caring a little bit more now about some of these, but again, it's not anything too extreme, but it cares a bit more. And you can kind of see this. I think one of the clear examples of where this differs is the more recent price action we actually saw coming out of the summer into September. We had the correction, and then where we've had our more recent correction. You can see with the longer term UDPI, it's still seeing this area as kind of a generally similar level of risk, although it did drop during that correction in September, and now it's plummeted down. And in fact, with the midterm UDPI, you can see it actually went up to a level of a little over 2, but then came all the way back down below 0 in this September correction before going back up. So if one was taking a bit more of an active trading strategy, maybe one would have taken profits on the way up here out of the summer, bought back in during the correction in September, and then sold back out, at least to some degree, in this run up to the new all-time high before this more recent correction we had. And then to an even greater degree, the short-term UDPI also plays out that way, where it's identifying that this run out of the summer, we had kind of tapped out a lot of our upside potential. Correction, we now move down to having reasonable, to actually having tapped out some of our downside potential, getting into the negatives, -1, and then shooting up all the way actually past 3 to the new all-time high, leading to this big correction. So if one wanted to be more actively trading through here, one could have been selling off as we get into here, buying in up here, selling off up here before this correction. Now again, none of this is financial advice, and I'm not saying that one of these UDPIs is getting better information than the other necessarily. It's just different information. If you're curious about where we are in the market cycle, this model, the longer term, probably gives you a better sense of that because it's not as concerned about this shorter term volatility. Whereas with the medium term and especially the short term UDPI, if one wants to kind of get a better sense of maybe more short term swing trade types of ideas, this might give a better sense of that. But again, not financial advice, not to say you should use one of these or should use one over the other necessarily, just different information. And my personal view of maybe how these are most usefully used is instead of using them in isolation, use them in confluence with each other. So for example, when we're up here in the spring, we can see that on the long-term UDPI, we're in a high-risk territory. We're above 3, between 3 and 4. That's high risk. That's a pretty high-risk time to be in. And so if you see that, then if you're looking at the short-term UDPI, you can say that, okay, in the short term, we tapped out our upside potential here. We had this huge correction to the downside here. And as we ran back up here again, the idea is that one could have been trading this, right, to sell off here, buy that dip, sell it off again. But one would have known that one was playing with fire a little bit to do that. One could have made those trades and been successful having done it with the short term. But really what this is saying is that we're getting close to the end. And so maybe you can get that to work once, but you need to be careful anytime after that. Maybe you can get it to work once, but after that, it's getting really risky to try to play this market because of how high risk we are right now. And similar things playing out in the medium term as well. And because all of these were at similar risk levels, the long term, the medium term, and the short term were all in high risk territory during that time, that would suggest that this is really an overheated point in the market where a correction is likely to be following. And that's indeed what we ended up seeing. Whereas with this kind of area over here, one might be able to play that a little bit more reasonably without being concerned that a huge maybe dump is coming, because we didn't get to that same high level of risk before. And so one, could have maybe just taken profits through this whole thing or just held through this whole thing because it doesn't seem like a market cycle top. And indeed, what we might end up seeing, we'll have to wait and see, but if the market continues to rally, this second correction might have been really a good accumulation zone, but it might just all be a part of a bigger move up coming out of the summer. We're just going to have to wait and see what happens. But that's how I kind of think about using these in confluence, is look at, are they all saying that we're a high risk zone? And if they are, that's a time to be really concerned. But if only one is kind of flashing really high risk, but the longer term isn't, that's maybe less concerning from a macro perspective. That might not necessarily mean we have to go into a longer bear market. That might just mean that this short-term movement was a little bit overextended, but the long-term upside potential was not getting as extended as it had. So we'll have to wait and see what happens, but that's the way that I interpret this information. So to wrap us up, I just wanted to talk a little bit then about what these different versions of the UDPI say about our current risk level for Bitcoin. And kind of as you could see in those previous graphs I was showing you, the long-term UDPI, the more macro one, thinks that we're in kind of relative oversold territory right now. So it's in this kind of green zone below -2. So essentially what that means is it thinks the upside potential here is larger than the downside potential. But we aren't, it is important to note we're not at a point, back like in late 2018 or the March 2020 massive dump, or even yet at what it got to during the summer. We're still a bit higher than that. So it's not to say that our downside is over, that the bottom is guaranteed to be in right now, but it's certainly saying that the downside potential is getting smaller relative to the upside. And again, when we've seen these levels for Bitcoin in the past, it's tended to occur to these kind of nice accumulation zones. So not financial advice, should make your own opinions, but that's what the long-term UDPI is suggesting right now. Midterm is telling a similar story. Now, interestingly, the short-term UDPI has actually become a little bit more undecided, and that I think kind of makes sense, right? We had this huge correction recently, this big dump downwards off of the all-time high, and we've been kind of just range-bound going sideways ever since. And so what the short-term UDPI is saying is that more short-term downside is plausible. It is possible. We could have a break of this range to the downside before we can then put our moves into the upside. That's totally possible. And in fact, that's also being allowed for in the longer term. It's just saying that in the macro perspective, any kind of short-term move to the downside is probably going to be more minimal relative to the upside potential we could plausibly be seeing. So we'll have to wait and see how it all plays out. But it is useful to note that the short-term UDPI is being kind of more undecided right now. And I think that makes sense because frankly, we could see more downside. You know, we had a wick all the way down to 42K. In the past, when we've had these liquidation wicks down to those levels, we oftentimes have gone back down to test them before moving back to the upside. Doesn't say we have to do that here, but essentially the short-term model would see that as being plausible. But it would also see being plausible moving to the upside. You know, that could very well happen as well. So those are some things that I wanted to talk about with this model. Overall, I think it does do a lot to improve on the previous version of the UPI. And again, I just think it's an improvement. I don't think the older version of the UPI we have been looking at was bad by any means. I just think that this new version is more efficient and also offers us these nice new things that we can look at, these new kind of methods, things that we can look at that I think are really useful. And the final thing I'll say about this new version of the UDPI that I think is helpful is that this model is a smart model. It learns, it's able to fit to early data, and then it's able to run. There's no hand-holding required. The model is the model, and it goes. And it turns out that this model will work not just for Bitcoin, but this exact same model we can apply to all these other assets we've been looking at, and it gives reliable, useful risk output. And I think that's important to note because one of the things that you always have to be cautious about with a model is if it's overfitted. And whenever you fit a model to a specific asset, you always have to be a little bit worried about that. Because it might be the case that you're not actually picking up about some fundamental aspects of the market that denote risk or high or low risk, for example. You might just be picking up on idiosyncrasies of that specific asset, things unique to that asset that might not predict the future all that well. Whereas if you have a model that's actually able to apply to a bunch of different assets and identify risk accurately for each of them, especially in those simulations in real time, which I have gone back and checked this model using those simulations of other assets, and it does work in real time. The benefit of that, in my opinion, is that suggests the model might actually be picking up on some more fundamental aspect of the market that denotes high versus low risk relative to potentially risking overfitting. And so that's something I think is another strength of this, where a lot of other risk models you might see oftentimes are fitted to a specific asset and they won't work across assets. Not to say those models are necessarily wrong, but you always have to be a little bit worried potentially that they're overfitting to that specific asset, and will they be able to perform well into the future? Are they just picking up on something on that specific asset's history, and will that carry forward into the future? Whereas with this model applies to any asset that we've been looking at, and it's been able to give useful output. And I think personally that just gives me more confidence in it because there's no human error possible there. There's no concerns that you're just really overfitting to one model. It's something that mathematically that it's on its own. That's able to learn. You know, it's not something that's human driven. It's something that's being machine driven. It is learning. It is being able to give these risk estimates. All right, if you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter. And remember, with the UDPI, and now with this new version of the UDPI, we're all going to make it.